Good evening, good morning, everyone. I see lots of people joining from around the region as well as from India. Welcome to our webinar series. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy. Today, we are going to talk about the nuts and bolts of indexing from index creators' viewpoint. We'll be covering 4 different learning outcomes. We'll be looking at some basic concepts and methodologies. We'll be then looking at sampling techniques. We'll then move on to rebalancing and trading. And lastly and finally, we'll be looking at smart beta as well as the future of indexing, where AI has a big role to play. I'm sure many of you have read about smart beta as well as indexing, and it's come in a couple of issues in the Financial Analyst Journal. Do take a look. You can Google and find out. Now we've got 1 hour for today's webinar, as for all our webinars, about 35 minutes of talking time, followed by an interactive Q&A. Do keep the questions coming. And if at all something becomes really difficult, we can request Christine to pause for a second or so and then clarify. But I don't think there'll be we'll want to do that. And we've got let me introduce the speaker to you, Christine Lu. She's a senior manager at Equity Index Group at FTSE Russell. Christine is very experienced in indexing. She has over a decade's experience in portfolio management, as well as quantitative research. She has worked with a few firms, including asset management firms in China. Christine has an MBA degree from the Chicago Booth School. And importantly, Christine is a fellow charter holder member. Now, without further ado, let me begin and hand it over to Christine. Just one more quick input to you to keep your questions coming on the Q&A box, not the chat box. Over to you, Christine. Thank you so very much for joining today. The stage is all yours.
Thank you, Mr. Kante. Appreciate the introduction. It's my honor to be here. Before we start, I want to thank CFA Institute for having me here and giving me this opportunity to present on the Practitioners Insight series. And thanks to the effort from our organizer, Ms. Kante, and also the event crew for putting all this together. And thank you all for joining online with us now. I greatly appreciate your time and the engagement. So today's topics. Today's topics is nuts and bolts indexing. In terms of agenda, we'll go over 3 topics. First, an overview of the index industry. We're going to talk about the evolution of investing and how index investing has grown dramatically over the recent decades. Second is index construction. After the section, you will have an overview on the 5 main steps involved in index construction process and understand how the different methodologies impact the final index build. The third one is smart beta and the future in AI. We'll talk about the smart beta strategy and how different types of approach have been developed over the years and the economic research behind those strategies. In addition, as big data is a key area focus for systematic investing, data processing and the data analytics technologies are extremely critical in providing data-driven insights in the modern world of investing, where we rely on data availability, data quality to improve our investment decision-making. Lastly, as Ms. Kante mentioned, we'll have a Q&A session. So please submit your question during the meeting. I look forward to hearing your questions and feedback. So, all right, let's get started with the first one, the evolution of investing. So I believe many of you already have more or less experience with index or benchmarks with your work in the financial industry, or have tracked some of the benchmarks as a measure of stock market movement. Here is a brief timetable, particularly showing the earliest indexes in the history. For example, the first 2 Dow Jones indexes launched in the 19th century, the Dow Jones Transportation Average and Dow Jones Industrial Average. Later in 1935, FT30 is the first UK stock market index was launched, and which later was replaced by FTSE 100. In 1957, in the US, S&P 500 was launched, and the true revolution of investing started from 1971, when the first index fund became available. Over the past half century, index business have grown enormously due to the start of passive index fund investing. Around the 1980s to 2000, many country and regional index series were launched, include the first India index, S&P, BSE, Sensex. Today we have 3 million indexes globally by Index Industry Association survey. Traditionally, the index can be classified by asset class, by geographic regions, or by sector or industry. Over time, pure sector indexes evolved into specific economic segmentations, and during that time, thematic index were developed. Thematic index can be cross-sector as well. Another innovation in indexing is smart beta strategy. It is the strategy trying to identify the drivers to the stock market returns. We'll come back to this concept in more detail a bit later. So here is a screenshot of example of index family. Investors will be able to find those index focus on asset class or focus on global or regional places. Before 1971, the time first index fund was born, indexes mostly served as a benchmark for performance evaluation. It is a hypothetical portfolio representing our market of coverage. Active managers are often compared to the benchmark or to be evaluated about their alpha generating capability relative to the benchmark. Index as an investment vehicle started from the passive index fund. In 1971, John McCall and David Booth started a 5 million index fund in the Wells Fargo pension fund. The fund was invested internally for 2 years until it attracts the first external investor. On the other hand, John Bogle, you may all know about the founder of Vanguard, started the first index fund trust in 1975, which later named the Vanguard 500 Index Fund. John McCall, David Booth, and Bogle are among the earliest pioneers in this index revolution. Exchange Traded Fund, ETF, is another innovation in indexing investing. In the 1990s, the first exchange fund called TIPS was launched by Toronto Stock Exchange. 3 years later, 1993, State Street launched the first S&P 500 Trust ETF. ETF is a basket of security traded on the stock exchange, just like stocks. It is a more flexible version, and it's also quoted real time. Decrement index is a structured product triggered by the low interest rate environment. The decrement index is designed to track a synthetic dividend. The fixed percent or the fixed point structured as a decrement is designed to be roughly the same as the realized dividend. Another interesting evolution in index usage is most recently the direct indexing. Direct indexing was started by the need of the wealth clients for taking account of after-tax performance. Direct indexing provides financial advisors an alternative way to manage index investing. Wealth investors can replicate index and manage for tax customization. Direct index is more expensive than you just buy into a plain vanilla index fund or ETF, but since it can be customized individually and created value to ultra high net worth investors. Let's take a look at how big the index industry has grown by the following couple of slides. First one, we use Russell US Index Series as an example. By end of 2020, over 10 trillion US dollar assets were benchmarked to Russell US index based on the investment and the Morningstar data. Russell US were mainly tracked by institutional assets and tracked by 69 of active US equity assets towards the end of 2020. Morningstar also traced the globally open-ended index fund and ETF from 2008. From 2008 to 2021, global index fund AUM reached close to 17 trillions. In year 2021, there's 1.3 trillion, the large net asset inflow into the index fund and the ETF. From roughly $1.5 trillion in 2008, from the left side, it grows 10 times the size over the last 14 years. Among all the countries, US is the largest player if you see the green bar in the index fund business, representing 70% of total global index fund business as of end of 2021. Additionally, another independent consulting firm, ETF GI, tracked the global ETF business since 2006. And the data also shows for the last 15 years from 2006, the ETF industry from less than $1 trillion reached to 10 trillion US dollar by end of 2021. The growth of index and the ETF investing is phenomenal, approximately more than 16% compounding annual growth. We mentioned about direct indexing. It is an innovation in the wealth front regarding index investing. So by now you see the big picture of cross-century history of the index business and the exponential growth of index fund and ETF business over the last decade and a half. Our second part of topic, let's take a deep look into index construction. Similar to any mutual fund, index portfolio is composed of a basket of securities. Let's take a look at the 3 different equity market indexes here. The left side one is the US large cap index, Russell 1000. The top right one is UK large cap index, FTSE 100. And the bottom right is US small cap index, Russell 2000. The color map shows the industry information in terms of their market cap percentage. The different colors represent the largest to smallest percentage within an index. For example, the orange represents top industry and the steel blue, the second largest. And the industry here is using ICB classification. If we compare the 3 indexes here, we'll see each index represents different index exposures. If we take a look at the dominant industry of each index here, we can find for US large cap at the left side, it's the tech sector and the consumer discretionary. While for UK large cap, the FTSE 100 is financial and the consumer staple. And for the Russell 2000, the US small cap is healthcare and the financials. As you may already know, the different industry respond differently to economic condition change. Therefore, when market condition change, we'll expect to see very different movement of the 3 indexes. Other than examining the industry exposure of index holdings, we can also use similar ways to check other fundamental characteristics of index constituents and better understand the index portfolios. Each index is constructed according to a set of rules, usually specified in its methodology. So what are some common steps involved in the construction process? The cycle at the left side, the cycle chart shows 5 main steps. Index construction started with identifying the target eligible universe. For example, what stock exchange or country or region we want to build an index on, and what type of securities are index targeting, defining an eligible universe is the first step. Second, within the eligible universe, how do we choose our index components? Do we want the index to represent a broad market, or we want it to be more selective to represent a specified segment? After we select the index constituents through the screening and the qualification process, the third step is to decide how do we weight those qualified stocks. Frequently used methodologies include market cap weighted, equal weighted, fundamentally weighted, or risk weighted. Although price weighted was adopted by the earliest Dow Jones series and the Nikkei industry, price weight is less commonly used in today's index build. The fourth part is setting the constraints. Constraints can be set up to avoid the deviation from broader market index or to satisfy diversification purpose. The last step in the cycle is review and rebalance. This is also an important step in the overall index construction. In index methodology, it will disclose how frequently the index is reviewed and rebalanced, and the principles for rebalance and the trading. Index methodology usually covers all the rules applied to the index construction, constituent selection process. We will also disclose how the index, it will usually for the index methodology, it's also going to disclose how the index is calculated, treatment of the corporate action items, and ongoing maintenance of the index. So usually it's the first place that investors want to go and find the detail to better have the knowledge about the index. We'll take a little bit more, talk a little bit more details about qualification process and weighting. So if you are familiar with portfolio construction in active managed mutual fund, you understand after giving a investment scope, an active portfolio manager will select qualified stocks using fundamental research with the purpose of achieving performance or other specified objectives. But here in index construction, we can see from the chart, index can have two completely different sides of objectives. One to the right is similar to an active fund with more selective and performance-driven objectives. And on the other side, the left side, the objective is to achieve broader market coverage. Depends on what kind of index product we want to build. Index can hold as many as thousands of membership to represent the overall market in one country. Like in the US stock market, there's thousands of total market stocks. Next to the broad market, there's a sampling methodology used by index fund, which has the objective as to track the broad market. The purpose of sampling usually is investment related. Sampling can be done by setting the representative criteria for the replicated portfolio, and after the sampling, those criteria will remain close to represent the original broad market. Sampling, the purpose of sampling is trying to get rid of unnecessary trading costs and avoid high illiquid stocks. So sampling usually, after the sampling, the portfolio usually get rid of stocks either too small or illiquid to trade, therefore potentially lower the trading cost. Let's take a look at a hypothetical sampling example using market cap as a representative criteria. In the example, portfolio 1 is assumed to be a broad market index. Portfolio 2 covers about 99% of the market cap of the market portfolio. And portfolio 3 covers a little smaller than 90% market cap of the market portfolio. If assume we have a tracking error target, and for the budget to be, for example, 1% or 3% or 5%, we were able to pick different sampling results based on the sampled portfolio 2 and portfolio 3. The testing result is shown in the right side of the chart. If you see the portfolio tracking error, for portfolio 2, it has a 0.6% tracking error, and the portfolio 3 has a tracking error of 4.6%. We mentioned about if we have 3 different tracking error budget, then we'll be able to decide which portfolio will satisfy the constraint of tracking error. In other times, this is a simplified example. Other times, only market cap coverage is not enough, and we might need to sort the other criteria, for example, industry or other different dimensions. Another important and interesting step is weighting. Commonly used weighting methodologies include market cap weight, equal weighted, means equal value weighted, and fundamentally weighted, risk weighted. Each type of weighting methodology expresses different views, and each has its limitations. For example, market cap weight will normally overweight mega cap stocks, and the market cap weight index are largely moved by very large mega cap stocks in the US market. Equal weight compared to market cap weight favors mid or smaller stocks. Fundamental weight is a strategy introduced by Refinitiv affiliates. Instead of weighting the stock in their market cap weight value, it weights the stocks based on fundamentally derived values. Fundamental weight favors value stocks in general. Risk weight index by using identified risk characteristics such as volatility or stock variance. Understanding the bias and the limitations of each different weighting can help us understand different performance results in changing the different market situations. The last step of the index construction cycle is the review and the rebalance. For the broad market index, the most important benefit of rebalance is to periodically take into account corporate action items, such as new IPOs in the market, stock spin-off, delisting, or any reclassification. For most non-market cap weighted index, periodic rebalance can bring drift back to the target weights. But more rebalance means more trading activities. Therefore, when we consider rebalance frequency, we want to balance the pros and the cons. Some index set buffer rebalance rules to better address and control unnecessary trading, using buffer rebalance or trigger the rebalance to set up the minimum deviation for executing the trades. So third one is today's topic about smart beta and the future with AI. Before we discuss further about smart beta investing, let's take a look at the rationale behind index investing and the smart beta concept. Based on Jim Farmer's efficient market hypothesis, when a stock market becomes more informationally efficient, where stock price reflects all available information about future stock values, active managers will be less likely to beat the market consistently on a risk-adjusted basis. Empirically, in the US stock market, probably the most efficient market in the world, multiple research and evidence show average active managers cannot beat the market average. S&P has conducted an active versus passive study called Spiva Research. The study measured active management funds against their relevant index benchmark across countries and worldwide regions. The latest result by the end of 2021, showing in the US more than 80% of large cap active managers cannot beat S&P over a 10-year investment horizon, and similar results for many other developed countries. It is a very interesting study showing when market become more efficient, we'll expect increased difficulties to consistently beat the market. The research is not saying the active manager is not having contributing to value. Just towards the investor, it is difficult to find the right alpha contributing active managers. Allocation purpose. So index investing is a very convenient way to participate in the growth of global market outside of our home country. Diversification also is another purpose. Marco Twist once commented, diversification is the only free lunch in investing. From the perspective of an institutional investor, we will consider the benefit of allocation to alternative returns, innovative industry or asset class that are not available within our own country. Here we have a hypothetical diversification example. If you can take a look at the correlation chart, the yellow highlight indicates highest correlation and the dark green be the lowest. We can see from, assume I hold a Nifty 500 by examining the correlation of asset returns, because the portfolio, the Nifty 500 has a relatively low correlation with the US small cap index Russell 2000. So I made a hypothetical portfolio blending half Nifty 500 and a half US small cap index. And the two assets, and running the two assets by backtesting on the blended index and compare with the original index. You can see from the charts, the lower two charts, they are on the rolling 3-year basis. The low left side of the chart is a standard deviation chart. The blue dot represent the blended portfolio, and the green line represent the original Nifty 500. The lower right hand of the chart indicate max drawdown, and the blue dot also represent blended portfolio. You can find the new blended portfolio has shown lower the portfolio volatility, especially at times the volatility is the highest. For example, around 2008, after 2008 and 9. And from the left side, right side of the chart, the max drawdown is also largely controlled. In theory, we know two risks usually ruin the long-run investment result, and the one is the drawdown. So this is just a hypothetical test, but you can certainly test on other combinations with any low correlated index or use other sector index that is new to your existing portfolio to achieve the diversification benefit. Over the last century, economic theories and empirical research study have also contributed to the development of systematic investing. The earliest one, or sometimes called the one-factor model, the CAPM model, capital asset pricing model, shows the market beta was able to explain roughly 70% of the stock market returns. And for any individual investor, allocating to the right benchmark or having the right investment direction is far more important than spending time on picking individual stocks. Since pharma-French 3-factor models, academic studies were actively set out to finding the drivers of stock returns. The 3-factor models use empirical research for stock market data up to 1990s, showing the 3 factors explained over 90% of diversified portfolio returns. Those factors are the beginning of smart beta strategies. In addition to market beta, the two newly identified factors from pharma-French 3-factor models, the small factor and the value factor, were initially utilized in many factor index products. Today, many more research have been conducted to identify potential new drivers of the stock market returns. Smart beta becomes a broader term, not only include the original value or size, but behavioral factors such as momentum. Mean variance approach is also based on efficient market hypothesis, where investors seeking the tangent portfolio with utilizing the mean variance efficiency. It is also another smart beta strategies explored by many investors. In recent years, AQR also published a paper to test on Warren Buffett's alpha. It further deciphered Buffett's consistent alpha return. With full respect to Warren Buffett's active management skill and the consistent overperformance, AQR paper discovered another driver, quality, in Buffett's portfolio alpha. And around 95% explained by the joint use of high quality and the leverage. Because of this finding, it turned a lot of interest from investors, also makes the quality factor one of the popular smart beta strategy in the last couple of years. There's an ongoing discussion and the debate surrounded with factors long-term effectiveness, factor risk premium diminishing over time, or the possible diminishing premium post-research publication. However, as long as systematic investing can achieve cost efficiency and deliver competitive after-fee alphas, more smart beta strategies will continue to evolve. As more alternative information and alternative data become available, it will also help bring continued innovation to the existing smart beta strategies. So that said, let's find out why AI technology is adding value to the smart beta or systematic investing in general. Machine learning uses computer program to enable computer to learn to discover patterns and insights from data, such as natural language processing, NLP, and deep learning, data analytics, data mining, and data pattern recognition. Artificial intelligence technology can further imitate human intelligence and perform tasks much faster than human. As investment decisions rely on big data, human will not be the machine on the speed and efficiency in processing large volume of data. Today, some of the technologies are already being used. For example, natural language processing we mentioned earlier, the techniques has applied to multiple investment areas. For example, the application in semantic index, that natural language processing technology can also process unstructured data, including news and transcripts, satellite data, and analyst reviews, and normalize those data into analytic readiness. In the wealth side, machine learning is used to filter out noises in today's overflow of information. We live in the information bust area. Filtering disturbing noises can also improve decision efficiency, which can help us to be focused on the useful information and be less distracted to the noises. With the advance in technology and the availability of specific AI technology, portfolio managers are able to create data-driven investment models for research testing and creating operational efficiency in asset allocation and portfolio management process. With those innovative technologies, we're able to develop cost-efficient investment alternatives to the general public. Regarding the future investment challenges, we all know that for systematic investing, data is very important. The investment industry are related with data processing capability, data quality, and also technology. Therefore, machine learning and AI are one innovative things in processing those data will be inevitably critical. Here is an example in AI and alternative data where it's already applied into some of the quantitative research space. Refinitiv StarMine model are developed in combining the existing quant research with machine learning and AI, combined with alternative data and analytics. The Refinitiv model have been using multiple techniques such as natural language processing, text mining, market-side analytics to provide high-dimensional data and powerful insights unique to the traditional smart beta factor approach. Not only the quant models incorporated historical data, it has also efficiently updated new market information, for example, analyst insights, as well as alternative data such as smart holding. With the availability of data processing technology, future products built on those models will bring smarter insights due to the capability for incorporating alternative data and the new information. Another example is text mining technology. It's machine learning utilizing in the processing unstructured data from event scripture, company filings, news component, and self-side research into utilizable structured data ready for analytics. Data capability and the speed of processing the unstructured data would dramatically shorten the time and shorten the decision-making, improve investment efficiency. To summarize, an index product become more acceptable to general public. When you decide on particular index to invest, we need to look at the index methodology to understand the investment objectives, the scope of coverage, and possibly the inherited tendency and exposure to the types of stocks. Exploring new sources of return will become more rewarding in the investment world than trying to pick stocks while the global stock market become more efficiently over time and technologies are more innovative with us. I expect to see more innovative index products over the next 10 to 20 years with the advanced machine learning and AI technologies, and expect to see active management focus more in allocation and the investment strategies selections. Well, I hope you find today's session useful and insightful, and I'll pass over to Ms. Kante for questions.
Thank you very much, Christine. Indeed, a very insightful and very elaborate presentation. Lots of questions in the Q&A chat box. And I suppose your presentation can be shared later on, right? I think Harshad
Yes.
can share it once we load it on the CFA Institute website, the presentation will be available. So Christine, I just wanted to start off with a simple question. You know, if you can explain, you are the index creator, right? And there are the asset management firms. Could you briefly just explain, you know, how it works? Like you create the indexes, the asset management firms use those indexes, and they offer it to the customers. How does it work?
You mean how do we usually create index, right?
Yeah, no, the ecosystem. Who are the biggest stakeholders? So you are, you know, for example, FTSE or S&P, they create indexes. Then there is the asset management companies like the BlackRocks of the world, and then there are the investors, and also there are the ETFs. So who are the stakeholders? Just very quickly on that, if you can just touch base.
Sure. So it's who is the index ultimate user, right? The stakeholder. So for FTSE Russell, we are more institutional investors. You mentioned about ETF asset managers. They are one part of the clients for us. The other part is the asset owner, for example, pension or other, you know, companies. They have an in-house they're asset owners. So they want to incorporate different passively managed index fund. So we have the biggest say for the two types of investors.
I wanted to, you know, jump to some of the questions, you know, which are there, and the questions just keep on pouring. Prashant wanted to understand if it would be possible to construct an investable global markets index consisting of all investable asset classes. Do we have any such index? I mean, in CFA Institute study in the first level, people would have heard that that efficient frontier, the most efficient asset is not there. But what are your thoughts? What is the closest?
You mean in the global asset?
Yes.
Asset? there's no efficient frontier theory, right? You mean the theory is the market is not efficient? Is
Sorry,
that this question, if I understand? Okay.
Let me, so is it possible to construct a investable global markets index consisting of all investable asset classes? It's a theoretical question, I suppose. And we know the answer,
okay.
but from an expert like you, would like to know the answer.
I see. So actually, there's a global index. For example, with FTSE Russell, we have a FTSE All World Index. They are actually investable assets, investable markets. They will be included in the index. But this index is market cap based. It's not for any optimization for efficient market theory. So this is a little different. So it's a broad market index covering all the investable markets in the world.
But it's an equity index, right? I mean, not across asset classes.
Not cross asset, yeah.
Right.
Yeah, yes, I want to add one thing is usually in equity, it's more advanced in building the index. On the fixed income side, the bond is going to be more index products in the later years. And it's a relatively newer space because the investment and particular different trading and involved with the bond and the fixed income side. So I think gradually we'll have all the multi-asset class for index for the availability in the global as well.
Right. Moving on, there's a person named Gitu. She's asking, she wants to know more about leveraged ETFs. How do leveraged ETFs work? Can you give a very brief insight on leveraged ETFs? And I'm sure leveraged ETFs are not there in India, as far as I know, but I'll stand corrected if somebody puts a response to that on the chat. But can you give a brief listing on leveraged ETFs? What are the risks involved? And if an investor wants to invest in a 2x MSCI India?
I see. I'm not particularly in the leverage index, but I think with my experience, leverage index you need to borrow. So there is a additional factor involved in the index is the interest rate. So leverage will include those type of things. So it's going to be more volatile than the index is not leveraged. So that's the basic difference. And the leverage part is hypothetical. So you will calculate daily interest. And sometimes it's going to be really just volatile relative to the normal index. So there's a 3x, sometimes there's a different leverage applied to the index.
I wanted to understand a little bit more on tracking error, Christine. Like, so you've got different types of asset. The index is the same. Let's say, we can call it as the S&P 500 index, and there are 10 asset managers, but each of the asset manager has got a different tracking error. So how do you explain that?
Yeah, tracking error is how closely you are with the benchmark. So in the other word, if you have no tracking error, you are relatively benchmark. So same beta benchmark market portfolio, but with the high tracking error, that alternatively saying you will supposed to have higher alpha. So if that's the difference with purely passive, we want to do very small tracking error to be benchmark like. The other way around is we want to have a larger tracking error, but the purpose is not the tracking error, but we want to increase the alpha that we can, when we deviate from the market cap, we want to produce the returns from those tracking errors.
Yeah, right. So I was really wanting to know about unintended tracking error. So for example, there is asset manager A and asset manager B. Both of them are using a computer to track an index. And asset manager A has got a tracking error of, let's say, 1.5%. Asset manager B has got a tracking error of 1%. So what mistakes might the asset manager B be making compared to asset manager A?
I see. So there's might be multiple reasons that create a tracking error. For example, if you are having different constituents and you are missing several constituents in your portfolio, then you will deviate from the percentage of constituents, deviate from the market cap or the entire market. The second is trading. If you increase the trading cost or the transaction cost, then you will deviate because you generate higher cost and relative to the benchmark. The third might be different with, for example, a different weighting. You have all the constituents, but you weighted differently than the benchmark. For example, if the benchmark is using free flow adjusted market cap, but your portfolio is using another different market cap or some of the different type of numbers. And that said, that's also something related with your data source. So if you're using different data source than the market portfolio using different vendors or different quarter of the price, then you will increase the tracking error to when you replicate the portfolios.
Right. Thank you. Mayank is asking, during the presentation, and I missed this, I'm sorry. He came across a term called buffer rebalance. Can you explain that a little bit?
Sure. Buffer rebalance is sometimes when you, for example, I make an example when you in asset allocation. If you have a target percentage for one individual stock, or you have a percentage for individual industry, then when the deviation happen, it can be very small. For example, it can has 0.01 or something like a very small deviation from the benchmark or the target. Are you going to trigger the transaction, to trigger the trading, or you want to wait until it's larger than 2%? For example, I make this up. The buffer is 1%, 2%, or something like deviate from the target, your target goal on the percentage, on the weighting. So if I explain clearly, so it's when you reach the buffer, you trigger the trading. When you are smaller, for example, you deviate a little bit. I have maybe, for example, 10 million in this stock is my target as a market cap for this stock. And it has right now, it's 9 million, but I think that's fine. It's not reached to the buffer if the buffer is 8 million. So it's like a 2 million deviation, then I'm not going to do the trading today and maybe to the next rebalance time when it's deviate larger. So this can help something that you control the transaction cost if it's just a short-term deviate, it's going to back, or it's too short and too small, you don't want to happen the transaction immediately.
Right. Thank you. I wanted to quickly go to this topic on, hotly debated topic on active versus passive. Do you truly believe in passive, Christine? So I suppose all your personal wealth is in index funds?
Mm-hmm. Yes, I think for me, it's a joint view because I'm very believe in technology and the data processing efficiency. I think the joint force with active and passive will be the future. The only thing I think why I believe in systematic investing is because it's a very low cost investment vehicle to the investors. And with the very low fee and the capability with the technology, it can generate a similar alpha as you hire a high expense, the alpha generating active manager. It's not saying there's no good active managers there, and also active research and investment is also having their space. There's a long short portfolio hedge fund. You also need a very active fundamental research to generate to those long short alphas. I think just applying to different ways, the active and the passive will need to work together. I think either one will want to catch the alpha left out with the beta. So I think a systematic research is focusing on smart beta, and the factor is due to the reason that it wants to get ahead with a low expense ratio. And the possibility is we utilize the big data and the technology to expedite and fasten the decision when we have new information and the new alternative data source. So that's something I think I would believe systematic investing will still grow with the innovation in the smart beta side.
Right. No, well said, Christine. I wanted to go on now to the AI ML piece, and you've given lots of examples on how this could be used. To my understanding, there's nothing on offering yet, right? I mean, you don't have an index which is true AI ML and or even AI ML, which is a dark box or even a gray box where a machine picks up stocks. Is that something that is available somewhere, or it's not?
We are actually in the process of building those type of index based on some of the technologies involved related with the machine learning technology. And right now we have something is the semantic index. It's actually already using NL, natural language processing machine learning technology in identifying different description of the company and revenues, and also the main business of the companies. So semantic index is already building on the machine learning technology. The star mine that I talked about, the quantitative model, is in the process of becoming to be a available index, probably this year or end of this year.
What are the regulatory constraints for that? Because I contributed to ISCO paper in which the undercurrent from experts seem to be that regulators will not allow dark box investing or even gray box investing where you cannot connect the input to the output.
Mm-hmm. Yes, understood. I think the way we utilize the machine learning is explainable, or something, the technology, you will understand what are the technologies utilized, because machine learning and AI, we are not able, the technology is still relatively new, and it's not going to replace the human thinking process. The part it utilizing is very more general. For example, natural language processing, it's actually able to work on the unstructured data and get the useful information. It's the same thing as we human process if we read a paper and get connected with different information. On the other star mine model, it's actually using the analyst revision. So for example, analysts are having quarterly revised view on one particular company. So those are solid data. It's not any like a black box. It's explainable to the consumer, to the customer, and to the potential investor. So these are something already utilized in different hedge fund strategy. And for index, it's just we need more structure into those index and to make it more transparent and explainable to the large general public.
My colleague Achal she wants to kind of differentiate between terms: active indexing, active investing, and you've got smart beta. Is smart beta similar to active indexing, or can you clarify, Christine?
I see. I think they are different. Active investing is, let me say it this way, active indexing, I don't actually have an active indexing example, but usually we call active ETF. So active ETF is more like managed by human interferes. So active ETF is different than smart beta. Smart beta is still a rules-based. So everything is actually specified in the index methodology. So active ETF is different than smart beta ETF. Smart beta ETF can be active, but smart beta ETF is not completely active ETF. So it can be specified earlier. For active investing, I think that's something I want to mention is active investing is always exist because you need to do allocation, you need to select the strategy you want to invest in. But for active stock picking, it's something that indexing systematic investing is relatively gradually replacing, because we have something we worked well on the passive side, and the pure stock picking and the pure active stock picking is probably become more difficult when the market information is more transparent and the market become more efficient.
Right. Palak, she has a question on other asset classes like real estate, commodity, alternative investment. So what's the trend there with these asset classes?
What are the trends, right?
Yeah,
I think I think they will become more important, especially with the inflation and other, lower interest rate environment. We are always great to find alternative ways to have those different part of the return generate different returns from different asset class. Commodity, real estate are new areas that are very good alternatives into the total index fund family, and will become very important when we think of multi-asset investing. So these are going to be become more utilized when we have the data access and we have more like a quality data to utilize.
Right. Narendra has got a question on ESG, and there's been a lot of talk on ESG in indexing, and there are lots of limitations and opportunities. Can you briefly talk on that for 30 seconds or so, Christine? ESG in indexing, limitations and opportunities.
Yeah, I see. ESG is a little broad concept. I think right now is within the Europe, they are more broadly utilized because of the regulation. In the US, because the regulation are more like diverse, and so that's I want to say for ESG, there's a very different perspective. For example, if it's Green Avenue or it's clean water, it's TPI, you have a different rules and applications. And so sometimes it's become very customized, depends on your investor's request. You might have a very different ESG index towards two different clients because their preference and the regulatory and also their company's preference or the views from the companies towards the ESG.
Right. Beng has a question on the rebalancing for smart indexes. Are there any guidelines for that? Maybe there are regulatory requirements. I don't know. Can you elaborate on that a little bit, Christine?
Smart beta strategy rebalance the same as normal market cap weighted. Unless sometimes, I want to say both are the same regulated. And if it's not active smart beta, then it's also going to follow the rules and the methodology of the rebalance. The rebalance will also have something, for example, if you are triggered or buffered way of rebalance, or sometimes you can have a different, like a quarter by quarter, the delayed rebalance schedule, but these are all specified in the methodology. So there should be no implications with, regulatory, issues.
Sampada has an interesting question, Christine. So there is, front running for an index fund. Investor may want to front run. Is that legal? Is that possible? What are your thoughts?
I think actually right now there's a lot of front run. I don't know if it's legally allowed, or not. But it's like hedge fund. You catch the efficiency and the information and the time of the rebalance, because when we announce the rebalance, it's going to take a couple of days, or sometimes it's longer. And even before that, you might follow and do something to replicate the rebalance and try to catch up the return. I don't personally know a lot of this, market, and I think it's exists. I can only say.
Let me go to two I hope easy questions, Christine. Lots of people are wanting to know what are good books on NLP and AI to read. That is question number one. The second question is on general stuff on indexing. If you can mention good websites or blogs or podcasts for people to go and follow. So two questions. One is AI, ML, and indexing. The second is general indexing.
Yeah, I think for AI and machine learning, I am actually not the expert. I'm also reading some papers internally and also from just the general knowledge. I probably wouldn't be really good, but other than data science, you might want to look at some of the machine learning books. I haven't really read any of the books on AI. But for indexing, I think there's probably a couple books I will recommend. One is the Trillions. I think this one is a very good historical from the history of the indexing to the index business reaching 1 trillion. So these are a good book to review and understand the history of the index business. And also for my personal, I think I gradually understand difficulties and trying to make a good judgment. I think for both, I would recommend is to know a little bit more about the behavioral science. I usually like the Nudge, the book Richard Thaler. But recently, I also started to read Noise. It's also about decision making and how to make better judgment. I think these will be helpful as indexing, understand systematic investing.
Right. No, sorry. The book you mentioned on indexing. What's the name again? How do I spell it? And is it called Trillion?
Trillions. TRILLION. Trillions. It's the Trillions. I think it's very interesting to read.
Got it. Thank you so very much, Christine. Just for our viewers, we've CFA Institute has come out with 3 courses on machine learning and AI. They are there on Coursera. I've been teaching that as well. So do take a look. And if you're a member, you can go and look at our the CFA Institute website to see some of the courses that are already there. It will give you a investment practitioner's understanding of what AI ML is. But that's it for today. Thank you so very much for joining us for this webinar. Thank you very, very much, Christine, for for spending time on creating the presentation, coming up early on the webinar, and really giving a very good session, delivering a good session. Thank you all.
Yes. Thank you, Mr. Khan.
That's all for today. Thank you.